Secrets of a profitable crude oil trading. Excellent opportunities are offered through crude oil trading to profit in nearly all market conditions. Due to its unique standing within the world's economic and political systems. In recent years also energy sector volatility has sharply risen, ensuring strong trends that can produce consistent returns for short-term swing trades and long-term timing strategies. Market participants often fail to take full advantage of crude oil fluctuations, either because they haven't learned the unique characteristics of these markets or because they're unaware of the hidden pitfalls that can eat into earnings. Besides, not all energy-focused financial instruments are created equally, with a subset of these securities more likely to produce positive results. 1. Learn what moves crude oil. Through perceptions of supply and demand, crude oil moves affected by global economic prosperity as well as worldwide output. Shrinking demand and oversupply encourage traders to sell crude oil markets, where rising demand and declining or flat production encourages traders to bid crude oil higher. Tight convergence between positive elements can produce powerful uptrends, like the surge of crude oil to $145.31 per barrel in July 2008, while tight convergence between negative elements can create powerful downtrends, like the August 2015 collapse to $37.75 per barrel. Price action tends to build narrow trading ranges when crude oil reacts to mixed conditions, with sideways action often persisting for years at a time. In the spring of 2020, oil prices collapsed amid the COVID-19 pandemic and economic slowdown. OPEC and its allies agreed to historic production cuts to stabilize prices, but they dropped to 20-year lows. 2. Understand the crowd. Professional traders extremely dominate the energy futures markets, with industry players taking positions to offset physical exposure, while hedge funds speculate on long and short-term direction. Retail traders and investors exert less influence here than in more emotional markets, like precious metals or high-beta growth stocks. Retail's influence rises when crude oil trends sharply, attracting capital from small players who are drawn into these markets by front-page headlines and table-pounding talking heads. The subsequent waves of greed and fear can intensify underlying trend momentum, contributing to historic climaxes and collapses that print exceptionally high volume. 3. Choose between Brent and WTI crude oil. Through two primary markets crude oil trades, Brent crude and West Texas Intermediate crude. WTI originates in the U.S. Permian Basin, comes from local sources, while Brent comes from more than a dozen fields in the North Atlantic. These varieties contain different sulfur content and API gravity, with lower levels commonly called light sweet crude oil. Brent has become a better indicator of worldwide pricing in recent years, although WTI in 2017 was more heavily traded in the world futures markets, after 2 years of Brent volume leadership. Within a band for years, pricing among these grades stayed, but that came to an end in the year 2010 when the two markets diverged sharply due to a rapidly changing supply versus demand environment. The U.S. oil production rise was driven by shale and fracking technology. Increased WTI output at the same time Brent drilling underwent a rapid decrease. U.S. law dating back to the Arab oil embargo in the 1970s aggravated this division, prohibiting local oil companies from selling their inventory in overseas markets. This ban was removed in 2015. Many of CME Group's New York Mercantile Exchange, NYMEX, futures contracts track the WTI benchmark, with the CL ticker attracting significant daily volume. The majority of futures traders can focus exclusively on this contract and its many derivatives. ETFs, exchange-traded funds, and ETNs, exchange-traded notes, offer equity access to crude oil, but their mathematical construction generates significant limitations due to contango and backwardation. 4. Read the long-term chart. Peaking in the upper $20 WTI crude oil rose after World War II, and entering a narrow band until the embargo in the 1970s triggered a parabolic rally to $120. It peaked late in the decade and began a tortuous decline, dropping into the teens ahead of the new millennium. Crude oil entered a new and powerful uptrend in 1999, rising to an all-time high at $157.73 in June 2008. The massive trading range dropped in between that level and the upper $20. settling around $55 at the end of 2017. As of January 2021, it was trading at about $47. 5. Bigger venue. The NYMEX WTI Light Sweet Crude Oil Futures Contract (CL) trades more than 10 million contracts per month, offering superb liquidity. However, it has a relatively high risk due to the 1,000-barrel contract unit and 0.01 per barrel minimum price fluctuation. Through NYMEX, there are dozens of other energy-based products offered, with the vast majority attracting professional speculators but few private traders or investors. The U.S. Oil Fund offers the most popular way to play crude oil through equities, posting an average daily volume of over 20 million shares. This security tracks WTI futures but is vulnerable to contango due to discrepancies between front-month and longer-dated contracts that reduce the size of price extensions. Oil companies and sector funds offer diverse industry exposure, with production, exploration, and oil service operations presenting different trends and opportunities. Diverging sharply for long periods, the majority of companies track general crude oil trends. These counterswings often occur when equity markets are trending sharply, with rallies or sell-offs triggering cross-market correlation that promotes lockstep behavior between diverse sectors. Some of the largest U.S. oil company funds are SPDR Energy Select Sector Fund, SPDR S&P Oil and Gas Exploration and Production ETF, VanEck Vectors Oil Services ETF, iShares U.S. Energy ETF, Vanguard Energy ETF. Reserve currencies offer an excellent way to take long-term crude oil exposure, with the economies of many nations leveraged closely to their energy resources. The bottom line: trading in crude oil and energy markets requires exceptional skill sets to build consistent profits. Market players looking to trade crude oil futures and their numerous derivatives need